All right, let's jump right in. Welcome back to The Deep Dive. We love tackling these, well, sometimes complex topics and breaking them down just for you. Today, we're navigating a world that might sound a bit dry, maybe, but trust me, it's absolutely critical. We're talking single audits. Our
Yeah.
mission, unpack the ins and outs of these audits for organizations getting federal financial assistance. We're going to make these regulations, which can seem pretty dense, really understandable, and hopefully, even a bit interesting. Let's get started. So, picture this. An organization, maybe it's a city, maybe a university, could be a nonprofit. They get significant federal money.
Yeah, could be for housing, research, infrastructure, lots of things.
Exactly. And when that federal assistance comes through, well, it's not just business as usual for their auditors, right? There's a specific higher level of scrutiny that kicks in.
That's precisely it. What's really fascinating here is that audits for these recipients, they have to follow two sets of standards.
Two sets. Okay.
Yeah. You've got the generally accepted auditing standards, GAAS.
Yeah.
So that's sort of the baseline for all audits.
Right.
The foundation.
Exactly. But then on top of that, they also have to comply with generally accepted government auditing standards. GAGAS, often called the Yellow Book.
Ah, the Yellow Book. Heard of that.
Right. So think of JAGAS as the foundation, like you said, and GAGAS adds these extra specialized requirements. It demands more documentation, more testing of internal controls,
More testing? Uh-huh.
and more detailed reporting on those controls. And this is crucial. It requires auditors to report on whether the federal money was actually administered according to all the applicable laws and regulations. Compliance.
So it's a much broader lens they're using.
That's broader, yeah.
That really paints a picture of, well, heightened scrutiny. So if GAGAS adds this layer, what actually prompted the Single Audit Act itself? Why did we need this specific law?
Well, the Single Audit Act was pretty groundbreaking, actually. The main goals were to make federal award audits more effective and, really importantly, to cut down the administrative burden on the recipients.
Burden. How so? Well, before the act, you might have, different federal agencies all sending their own auditors in. They'd be looking at the same financial statements, maybe for different grants. It was just inefficient.
Ah, okay. Multiple audits, same organization. Sounds messy.
Exactly. So the Act, which is governed by Title II of the Code of Federal Regulations, 2 CFR 200.5050 people usually just call it the Uniform Grant Guidance. It created this consolidated approach.
Consolidated. Makes sense.
And the key threshold is pretty straightforward. If an entity expends $750,000 or more in federal assistance in their fiscal year, they must have one of these audits.
$750,000, that's the magic number.
That's the tripwire, yeah.
Yeah.
Spend less than that, and you're generally exempt for that year.
Okay, so that 750K threshold is clear. But you mentioned the Act allows two types of audits, a single audit or a program-specific audit. What's the difference there? When would you use one versus the other?
Good question. The program-specific audit is much more limited. It's really only an option if the organization is spending federal money under just one single federal program.
Just one program.
Right. Not multiple grants from different places.
Yeah.
And a really key point, it doesn't require a full financial statement audit.
Ah, okay. No big financial statement audit needed.
Correct. Now, if there isn't a specific program guide available for that one program, the auditor still has responsibilities similar to auditing a major program in a single audit. But yeah, for most places getting a mix of federal funds, the big, comprehensive single audit is going to be the way to go. It's the default, really.
That makes sense. So most organizations crossing that threshold will need the full single audit. So what are the auditors really trying to achieve then? What are the main goals?
A single audit really has two main objectives. First, yes, they audit the entity's overall financial statements, like any regular audit. But they also issue a separate report on something called the Schedule of Expenditures of Federal Awards.
CFA.
CFA.
Okay, what's that show?
It basically lists out exactly how much federal money they spent during the year and on which federal programs.
Yeah.
It's a transparency thing.
Got it. And the second objective?
The second big one is a full compliance audit of those federal awards, all the ones they spent during the year. This leads to more reports specifically, one on compliance for what are called major programs and another on the internal controls related to that compliance.
Okay, major programs. We'll need to unpack that. But first, you mentioned something about materiality being different.
Yes, this is a critical difference. In a normal financial audit, materiality, whether an error is big enough to matter, is looked at for the financial statements as a whole.
Right, overall picture.
Exactly. But in a single audit, Materiality is considered separately for each major program.
Separately. Wow.
Yeah, so a relatively small error within a major federal program could be deemed material for that program, even if it wouldn't move the needle much on the overall financial statements.
That's a huge difference. It really highlights how granular these audits get. So, okay, that leads perfectly to the question.
Right.
How do they decide what counts as a major program? Is it just the dollar amount, that 750K again?
Generally, yes. The starting point for a major program is one that expends $750,000 or more in federal assistance,
Okay, so the same threshold?
usually. But it's not just about the dollars. Smaller programs, Kite B programs as they're called, can be bumped up to major status if they're identified as high risk,
High risk. Based on what?
based on a specific risk assessment process that's laid out in the guidance.
Yeah.
So it ensures proper oversight even for programs that don't hit that initial dollar threshold but might have other risk factors.
Okay, so risk plays a big role too.
Absolutely. And one more clarification of who does this apply to. It covers recipients, like a city getting money directly from, say, HUD.
Right, the direct receiver.
And it also covers subrecipients. So maybe a local nonprofit gets funds from that city, which originally got the money from HUD. The nonprofit is a subrecipient.
Okay, so it flows down.
It flows down. But importantly, contractors like, an electrician, the city hires for work on a federally funded project. They are not subject to these same single audit rules. Their relationship is different.
Got it. Recipients and subrecipients, yes. Contractors, no. That's clear. So, we've sketched out the landscape. Now let's zoom in on the players involved. Because understanding who does what, the organization getting the money, the auditee, and the auditors themselves, that seems crucial for this whole system to work. What's on the auditee's to-do list?
Yeah, the auditee responsibilities are pretty substantial. Let's start with picking the auditor.
Okay.
It's not like just hiring any consultant off the street. Federal procurement standards require a competitive process. They want to ensure genuine independence.
Competitive process, meaning?
Meaning, no just picking one firm without justification, no giving preference just because a firm is local. They need to evaluate auditors based on responsiveness, their actual government auditing experience, the qualifications of their staff, and their peer review results. How other auditors rate their work.
Okay, so a thorough vetting process.
Definitely. And there are strict conflict of interest rules, too. For instance, if a consulting firm helped the auditee develop their plan for getting reimbursed for indirect costs, they generally can't then audit those same costs if they were over, say, $1 million in the prior year.
Right, gotta keep that separation. What else is the auditee responsible for?
Report submission. This is a big one. The auditee has to submit the whole audit report package electronically. They use a specific online form called the data collection form.
Okay, electronic submission, and there's a deadline.
Oh yeah, a tight one. It's the earlier of 30 days after they receive the final auditor's report, or 9 months after their fiscal year ends, whichever comes first.
30 days or 9 months? Wow, okay.
And these reports, they have to be kept for 3 years, and they're generally made publicly available. Transparency again.
Makes sense. What goes in that package?
It's got to include their financial statements, naturally. A summary schedule detailing what happened with any findings from the prior year's audit, all the different auditor reports we'll talk about, and very importantly, the auditee's own plan for corrective action, how they're going to fix any problems the auditors found.
Okay, so they have to show they have a plan to fix things. That seems like a significant administrative task for the auditee.
It definitely is.
Now let's flip the coin. Let's talk auditor responsibilities. When auditors step into one of these single audits, what are they digging into that's different from a regular financial audit? What's their unique focus?
Right, the auditor's scope is much broader. Yes, they give an opinion on the financial statements and that CFA schedule we mentioned. Are they fairly presented?
Standard stuff there.
Kind of. But their work goes way deeper into compliance and controls. They have to specifically evaluate internal controls, check compliance with all those federal rules, and they must follow up on any findings from previous audits.
Okay, so internal controls, what exactly are they looking at there?
Their focus for internal controls is specifically on the controls related to compliance for the major programs. Not necessarily everything, but definitely for those key major programs. They use established frameworks, like the ones from the U.S. Comptroller General or COSO, to evaluate these controls.
Got it. Focused on major program compliance controls. And what about testing compliance directly?
They design and perform tests on the actual transactions involving federal awards. The aim here is to get comfortable saying there's a low assessed level of control risk of non-compliance for those major programs.
Low risk, meaning they feel the controls are working.
Exactly. They want to be confident the organization has strong safeguards to make sure federal money is used correctly. So, for example, if they're testing cost principles, they might pull a sample of payments and check if the costs were allowable, necessary, properly documented.
Makes sense. Checking the receipts, basically.
In a way, yeah. Or, for procurement rules, they'll look at how purchases were made. Was there open competition? Were procedures followed? If they're testing participant eligibility for, say, a benefits program, they'll check if the people receiving benefits actually met the criteria.
Okay, real detailed testing.
Very. And if they find controls aren't effective, they have to report those issues as either significant deficiencies or the more serious material weaknesses. And finding weak controls usually means they have to do more direct testing of the transactions themselves.
So weak controls mean more work for the auditor.
Definitely. Their ultimate goal is to provide reasonable assurance, not absolute, but reasonable, that the auditee followed the rules in all material respects for those major programs. They're trying to catch errors, whether they're accidental or, intentional noncompliance.
And a lot of these rules they're testing against come from that uniform guidance.
Precisely.
Yeah.
That 2 CFR 200 we mentioned earlier, it breaks down into a few critical areas auditors focus on. First, you have administrative requirements.
Okay. Like what?
This covers the whole grant life cycle, really. How they control federal funds internally, how they handle any income the program generates, those strict procurement standards we talked about, open competition, documented procedures.
Right.
Also, how they monitor program performance, how they oversee any subrecipients they pass money to, record retention rules, even how they manage any property bought with federal funds.
Yeah.
It's all about responsible management.
Stewardship, yeah. What's the next big area?
Cost principles. This is huge. It defines what costs are generally allowable and unallowable when using federal money.
Allowable versus unallowable? Key distinction.
Absolutely. The basic tests are, is the cost reasonable? Is it necessary for the program? Was it allocated properly to this program?
Okay. Examples.
Sure. Generally allowable costs might be things like employee salaries and benefits for time spent on the grant, equipment needed for the project, direct materials, travel if it's necessary for the grant, things like that.
Makes sense. And unallowable.
Things like entertainment costs, fines and penalties, alcohol, costs of organizing the entity itself, usually, lobbying costs, generally, things not directly related or specifically prohibited.
Got it. Clear boundaries.
And even how they allocate indirect costs overhead that has to be done using a method that's fair, reasonable, and applied consistently.
Okay. And there was a third piece auditors use.
Yes, the compliance supplement. Think of this as the auditor's detailed playbook for specific federal grant programs.
The playbook. I like that.
For almost every major federal program, it outlines the specific compliance requirements that need to be tested and often suggests audit procedures. Things like, were the activities performed actually allowed by the grant? Was cash managed properly to minimize time between drawing funds and paying bills? Were participants eligible? Were reports submitted correctly and on time? It's incredibly detailed.
So auditors aren't just making this up. They have a guide.
Oh, absolutely. This supplement is indispensable for single audits. And of course, running through all of this, they always have to follow up on findings from the prior audit. Did the auditee fix the problems identified last time? They have to check that.
That's a really thorough look at the auditor's side. Okay, this leads us right to the finish line, sort of. The audit reports. All this work culminates in reports. How do these compare to what you get from a typical financial audit? Sounds like it's more than just one report.
Oh, significantly more. You're absolutely right. A single audit results in 5 distinct reports. Much more comprehensive.
5 reports. Okay, let's list them out.
Okay, report number 1. The financial statement report. This is familiar. It's the auditor's opinion on whether the main financial statements are presented fairly, following GAAP, generally accepted accounting principles.
Standard opinion on the financials. Got it.
Number 2, the CFA report. This is an opinion specifically on that schedule of expenditures of federal awards we talked about. Is that schedule presented fairly in relation to the financial statements as a whole?
Okay. Opinion on the federal spending schedule.
Number 3, the GAGAS report, often called the Yellow Book report. This one reports on internal control over financial reporting and on compliance with laws and regulations that could directly affect the financial statements. It's broader than just the federal awards here.
Right. The government auditing standards report.
Number 4, and this is really unique to single audits, the single audit report itself. This gives an opinion on compliance for each major program, and it also reports on the internal control over compliance for those major programs. It also includes specific statements about the auditor's independence and how they considered fraud risk related to federal awards.
Wow, an opinion on compliance for each major program. That's specific.
Very specific. And if they find material noncompliance for a major program, this is where they'd issue a qualified opinion or even an adverse opinion on that program.
Okay. And the fifth report.
Number 5, and this is often where the action is, the schedule of findings and question costs. This is a detailed summary. It lists the types of opinions issued in all the other reports. It identifies any material weaknesses or significant deficiencies found in internal controls. It lists any material noncompliance. It clearly identifies which programs were audited as major. And critically, it details any known or likely questioned costs the auditors found.
Question costs. Okay, that sounds important. What specific findings have to go into that schedule? This sounds like where the problems get officially flagged.
Exactly. This is where the rubber meets the road. Auditors are required to report certain things here. Definitely any significant deficiencies and material weaknesses in internal control over the major programs. Also, any significant instances of abuse they found related to major programs.
Abuse, too. Okay.
Yes, and any material noncompliance with federal rules related to those major programs. And then, crucially, question costs. Any known or likely question costs that are over $25,000 must be reported.
$25,000 threshold for question costs.
Right. So the guidance gives an example. Say an auditor finds $36,000 in rent subsidies paid out under a major housing program, but the tenants actually exceeded the income limits. That $36,000 is a questioned cost over the threshold, so it must be reported in this schedule.
Okay, that's a clear example. What else gets reported?
They also have to report the reasons if they issued anything other than a clean, unmodified opinion on any major program. Any known or likely fraud they found that affects a federal award must be reported here. If the auditee's summary schedule of what they did about prior audit findings seems materially misrepresented, the auditors have to report that too.
So a real spotlight on any issues found.
Absolutely. And just a quick note on documentation. Both the auditor and the auditee had to keep all the audit work papers and reports for 3 years after the report is submitted. Audit trail is key.
3 years. Got it. That level of reporting detail is really something. So this brings us back to the methodology a bit. With potentially hundreds of federal programs out there, how do auditors actually pick which ones get that intense major program scrutiny? You mentioned a risk-based approach. How does that work?
Precisely. It's not arbitrary at all. The uniform guidance lays out a very specific 4-step risk-based approach for determining which programs will be audited as major.
4 steps. Okay.
And the auditor has to document their analysis in their work papers. They consider things like their own past experience auditing that program, any oversight activities by the federal agencies themselves, and the inherent risk of the program. Is it complex, new, prone to error?
Right. So let's walk you, the listener, through those 4 steps auditors use.
Okay. Step 1. Identify the big programs. These are called Type A programs, generally, and that's the $750,000 expenditure threshold we keep mentioning, though it can be higher for very large entities. Everything else, all the smaller programs, are Type B.
Okay, Type A are the big ones, Type B the smaller ones. Step 2.
Step 2. Identify which of those big Type A programs are actually low risk.
Low-risk Type A, how do they qualify?
To be low risk, a Type A program generally needs to have been audited as major in at least one of the last 2 audit periods. And in the most recent audit, it must have had no material weaknesses found in its internal controls, no modified opinion issued on its compliance, and no question costs that exceed 5% of its total expenditures for the year.
Okay, so clean bill of health recently, basically. Step 3.
Now look at the smaller Type B programs. The auditor uses professional judgment to identify which Type B programs are high risk. This involves looking at various risk factors.
High-risk Type B, using judgment.
Okay, step 4.
Step 4. Define the final list of major programs. This includes all the Type A programs that were not identified as low risk in Step 2. Plus, it includes those high-risk Type B programs identified in Step 3, but only as many as are needed to meet certain overall audit coverage requirements.
Coverage requirements, what are those? Yeah, there's a percentage rule. Auditors have to test enough major programs to cover at least 20% of the total federal dollars the entity spent, if the entity itself is considered low risk. If the entity is not low risk, the auditors have to cover at least 40% of the total federal expenditures.
20% for low-risk auditees, 40% for others. That ensures a decent chunk gets audited closely.
Exactly. It ensures sufficient audit scope across the board.
So, drilling down on risk, What kind of factors would make a federal program seem high risk to an auditor, even if it's a smaller Type B program? What are the red flags?
Several things can flag a program as potentially high risk. Maybe it involves multiple internal control structures, making it complex. Or perhaps the organization has weak systems for monitoring any subrecipients they pass funds through.
Okay. Weak monitoring is a risk.
Definitely.
Right.
Also, if a program hasn't been audited as major recently, complexity is a big factor, like programs with really complicated eligibility rules for beneficiaries. Those are inherently riskier.
More rules, more chances to misstep.
Right. And also programs that are new or in the early phase of their life cycle. The requirements might be untested or the organization might still be figuring out the processes. That adds risk.
Okay, that makes sense. Now, flip side. What makes the auditee itself, the whole organization, considered low risk? What earns them that lower 20% coverage threshold?
To qualify as a low-risk auditee, an organization generally needs a good track record. They need to have had single audits performed annually for the last 2 consecutive years.
I mean, consistent audits.
They need clean opinions on their overall financial statements, unmodified opinions. And crucially, under GAGAs, they can't have had any material weaknesses identified in their internal control over financial reporting.
So good financial health and controls.
Yes. Also, no going concern issues mentioned in the reports. No significant doubts raised about their ability to continue operating. And then looking at their major programs from the prior audit, the Type A ones, those programs can have had material weaknesses in internal control over compliance, question costs over 5% of their expenditures, or modified opinions issued against them.
Wow. So it's a pretty high bar to be considered a low-risk auditee. You need consistent, clean audits across the board.
It really is. It reflects sustained, strong financial management and compliance performance.
Whew. We have covered a lot of ground today. We've gone from, understanding the unique multi-layered requirements of single audits.
Yeah, the GAA plus GAGAS Foundation.
Right, to the very distinct and pretty significant roles of both the auditees and the auditors.
A lot of responsibility on both sides.
Definitely. Then the really comprehensive reporting, those 5 different reports.
Highlighting findings and question costs.
Exactly. And finally, that strategic risk-based approach auditors use to decide which programs get the most intense focus. It's truly been a deep dive into accountability for public funds.
It really has. And what becomes, I think, abundantly clear is that government audits, and single audits in particular, involve significantly more work, more responsibility than your standard financial audit.
Yeah, seems that way.
The primary focus is just different. It's laser-focused on giving the public and the government providing the funds confidence. Confidence that the laws and rules were followed, that the internal controls over compliance are strong, and that any significant issues, any non-compliance, are brought to light.
It really boils down to ensuring taxpayer dollars are accounted for and used the way they were intended.
That's the core of it, yes.
Yep. So as you, our listener, reflect on all of this detail, here's a final thought to maybe chew on, something to explore further. We've seen the incredible depth of oversight and specialized auditing required for federal funds. How might applying similar levels of detailed specialized auditing maybe focused on compliance with stated goals or internal controls over specific processes? How might that benefit transparency and accountability in other large-scale areas? Maybe huge private philanthropic grants or major corporate initiatives like sustainability reporting.
That's an interesting question, applying that level of rigor elsewhere.
Yeah, just something to think about. What really stands out to you as the most important takeaway from our deep dive today into the world of single audits?